Now, as a part of short-term items, what we will be discussing is, we'll be talking about account receivable. That is what we generally understand as debtors, right? So when you sell goods or when you sell services, account receivable aspect is what is covered here. And then inventory. So we will talk about account receivable and inventory to begin with. Now, in all of these, as I told you, we'll talk about when should we recognize. Then, whenever we have account receivable, that is, now see, I will gradually reduce the usage of sundry debtors and I'll more and more refer to it as account receivable. Account receivable are nothing but in line with your trade.
It's 11:30.
In line with your trade or operation, if you have to receive some amount when you sell goods or services on credit, this gives right to account receivable, right? Now, for example, if I sold goods at 10,000, I will say debit account receivable 10,000, credit income or revenue 10,000. Okay, this is a simple thing. Now, subsequently, what happens is this 10,000 rupees or $10,000, the customer has to pay me. Now, there may be cases where I feel the customer will not pay me the amount. And what do we do in that case? Whenever the customer does not pay me the amount, or whenever the customer is doubtful that they will not pay me the amount, what do we recognize at that point of time? If the customer does not pay us the amount, what do we do? Or what do we recognize? We recognize something called as bad debt. Now, this bad debt is also called as credit losses. And the term that we used when you did accounting as per the Indian GAAP, you would have said provision for bad debt. Now, here we will say allowance for bad debt or allowance for credit losses. See, these are the terms you must be gradually getting comfortable with. So we'll call what? We'll not call it provision for bad debt. We'll call it allowance for credit losses or allowance for bad debt. So as a part of receivable accounting, we will understand recognition, credit losses. Credit losses is nothing but your bad debt, and factoring. Factoring is a case where the entity sells its receivables. So when we come to factoring, we'll understand about that. Then for inventory, we'll understand what are the items to be included in inventory, cost flow assumptions, whether you will use a FIFO, LIFO, weighted average. Please remember, LIFO is not permitted under IFRS, but LIFO is very much permitted in GAAP, in US GAAP. Then calculation of cost of goods sold using different methods, FIFO, LIFO, etc. Then inventory errors, what is the impact? And the valuation principles, lower of cost or market and lower of cost or NRV. Each one of them we will be discussing in detail. Now, to begin with, when we start or when we talk about account receivable recognition. Now, for account receivable recognition, it is a very simple thing. Whenever there is a revenue on accrual basis, you will recognize account receivable. Now, at what price? At the transaction value. Okay. At what price? At the transaction value. In normal course of business, when you enter into transaction, you will recognize it using the transaction price or transaction value. Right. Sometimes what happens is there may be financing element. For example, cash price is 10,000. 1 year credit, if you take, the price is 12,000. Meaning to say, if you pay upfront, you can buy the product at 10,000. If you pay after 1 year, you have to pay 12,000. Now, in these cases, what we do is, though we are supposed to collect 12,000, entire 12,000 is not revenue from sale of goods. So what we do in this 12,000, we would say 10,000 is our revenue and balance 2,000 represents our interest income or other income, because only 10,000 can be attributed to sale of goods, right? So that is the first part. Now it's very simple. Whenever you sell goods, you will recognize that. Subsequent and very important part is your credit losses. Credit losses, because we have sold goods on credit and the customer may not pay us the full amount, because of which we have to recognize credit losses, and this is done by creating something called as allowance for credit losses, not creditor losses. Okay. Now, in the balance sheet, when we present it, we will say trade receivable or account receivable, let us say 10,000 less whatever is the allowance for credit loss, let us say 2,000. So 8,000 will be the net amount presented. This reduction, the allowance for credit losses, which reduces the receivable balance, is also called a contra account. So why contra account? Because it is an account having a contra balance, and that contra balance is used to offset the main account balance. Right. Now, let us say allowance for credit losses for the current period is 2,000. So what you will do, this 2,000 will have two impact. Your allowance for credit loss will have two-sided impact. One is P&L as an expense, and another one is balance sheet as a contra account to account receivable. Any doubt so far? Account receivable, when we talk about, normally all account receivable should be classified as current assets only. Normally, all account receivable should be classified as current assets only. But then, in some cases, account receivable may be classified as non-current. Now, you might be wondering, sir, when account receivable is a part of my operating cycle, how can account receivable be non-current? See, we do not calculate operating cycle for each and every customer. We calculate operating cycle on an average. Now, it may so happen that most of our customers pay us within, let us say, 180 days. One specific customer, we gave a credit period of 2 years. Normally, my operating cycle is 180 days only. But one customer, exceptional customer, I gave a credit period of 2 years. Right. Now, please remember, current asset or current portion, whatever we say, that will be recognized at the account receivable amount less expected or allowance for credit loss. Now, how do we calculate this allowance for credit loss? This allowance for credit loss basically tells us that the entity is not expecting that it will collect the full amount. So if I say 10,000 is my account receivable and 2,000 is my credit loss allowance, I am expecting to collect 8,000, right? Now, whenever in exceptional circumstances, when an account receivable is classified as non-current, in that case, what you have to do is you have to calculate present value of amount expected to be received. Now, what does this mean? This basically means is, let us say, amount will be received 8,000 at the end of year 2. Okay. Now, if it will be received at the end of year 2, when you have to value it at 0.0, you will discount this by 2 periods and applicable rate of interest, let us say 10%. And this 8,000 should be presented as present value. So whatever is the expected cash amount, you will present it at as the present value, right? So 8,000 divided by 1.1 whole square, if you do. If at all you have any difficulty in following present value, future value calculation, please let me know. I will give you the relevant resource for that. Okay, so 8,000 divided by 1.1 divided by 1.1, we get 6611. So then what we do, 6611 is my opening balance for year 1. Interest at 10%, 661. This again becomes my income. This becomes my income. Payment, no payment has been received. Closing balance, 6611 plus 661. It is 7272. Second year, 7272. interest 727, closing balance would be 2 plus 727, closing balance is 7999, which can be rounded off to 8,000, right? So if it is a current asset, and most of the cases, 99% of the times, you will classify it as a current asset, where you will say the gross value of account receivable minus allowance for credit loss. If it is a non-current asset, you will take present value of the cash that is expected to be realized, and accordingly you will present that in the balance sheet. So as we have seen, you have to make an allowance for credit loss, which is a contra asset, that is a contra account, which reduces the account receivable on the balance sheet. Now, in examination, the questions you will get is, if this customer account, or if this account receivable is wrongly recorded, then what is the impact on the balance sheet? So such kind of questions will be tested more than straightforward recording transactions. Okay. Then this account is used to keep track of management estimate for the amount of account receivable that the entity estimates it will not be able to collect. So when I look at the allowance for credit losses account, I will see that what is the amount that the management feels that they will not be able to collect from us. Okay, so that is what is given. Then the credit loss expense is the income statement account used to keep track of the expenses. We have discussed the current and non-current portion. Current account receivable are reported in the balance sheet at net realizable value. That is nothing but net of allowances for credit losses. Sometimes there may be sales return. We will anyways reduce that from the customer's balance. Billing adjustment, excess billing, short billing, that is also adjusted. Non-current receivables are measured at net present value. Now, one area in receivables where a lot of students get stuck is your movement from year to year, credit losses. For example, let us say we are in year 1. Year 1 sales, please follow carefully, is 100,000. At end of year 1, 2% is expected credit loss. So credit loss amount is equal to 100,000 into 2%, which is 2,000. In examination, if you have to calculate quickly, whenever you see a percentage, what you have to do is, if there is percentage, single digit percentage, what you have to do is take 2 digits and put a dot here. 2% into 1,000 becomes 2,000. So if it is 1% of, let us say, 100,000, 1% means these two will go off 1,000. If it is 10%, this means one of these will go off. Okay. And 10,000 will be the remaining part. So if it is 20%, you can just multiply this by 2 and you can get the answer. Some, quick tricks to save time in the examination. Now, 2,000 is the expected credit loss. So carrying amount is equal to 98,000. Now, what will be the entry? Entry will be debit credit loss 2,000, credit allowance for credit loss 2,000. Please remember, this is your income statement item. This is your balance sheet item. Now, this credit loss is nothing but your bad debt expense. Now, 2,000 we have done. Let us say in year 2, actual bad debt is case 1, 1,500. Case 1 is 1,500. So if actual bad debt is 1,500, I already have allowance of 2,000. What I will do is allowance for credit losses 1,500, debit, credit customer 1,500. Or there can be one more layer of entry added where you can say debit bad debt 1,500, credit customer 1,500, first entry. Second entry is, instead of customer, here you will have bad debt, right? So please remember, when I actually get the bad debt expense, this bad debt expense is not being taken to P&L. It is being offset against the allowance account which I have created earlier. Now, what will we do with the 500 of balance? See, opening balance is 2,000. Out of this 2,000, 1,500 I have utilized here. I have 500 more. And let us say closing allowance required is 2500. Okay, now I already have 500. So what I will do? I will create allowance for 2000. That is how I will do. Now come to the second scenario. Second scenario, let us say actual bad debt is 3000, which means I have allowance of only 2000, but actual bad debt is 3000. So what will I do? I will say debit bad debt 3000, credit customer 3000. Then debit allowance. I don't have 3000, I have only 2000. That debit bad expense 1000. That is your bad debt expense. Or what you can simply do is, just to avoid confusion, debit allowance 2000, credit bad debt 2000. So out of 3000, 2000 is debited to the allowance account, and the remaining 1000, this 1000 is taken to your expense in the P&L. So always remember, any bad debt expense, first I will knock it off against allowance. If any amount is not being paid by the customer, first I will knock it off against the allowance. For any shortfall, I will transfer that to income statement. Now, by doing this, this 2000 becomes 0. And if I need 2500, I will create an allowance for 2500 afresh. So if you look at expense for year 2, what you have to do is, first, closing allowance required. $2,500 totally, minus opening allowance. I have 2000 plus bad debt expense, which is 1500. So 2500 minus 2500. 2500 minus 2500 plus 1500. 2000 is the expense. Okay, that is what is created as allowance here. Then in the second scenario, closing allowance is 2500, opening allowance is 2000, bad debt is 3000. So here 500 plus 3000, 3500, which is nothing but 2500 of allowance and 1000 of this particular expense. So much of detail may not be tested in the examination, but it is good for your understanding, right? So whenever you have to calculate the expense, simple thing what you can remember is closing minus opening, that is one part of expense, plus bad debt expenses, another part of expense. Or you can say closing minus opening minus bad debt expense also. That is, whatever is there in the opening, first I will use it for expensing of the bad debt, and whatever is the closing needed, the difference of that will be the expense for the fee period. Now, whenever we create allowance of our credit losses, we are trying to estimate the credit loss in the year of revenue itself. So what we are saying basically, in this year, if I have made 100,000 of revenue, out of that, how much is the expected bad debt? See, bad debt may happen in the future, but if that bad debt pertains to, or if that credit loss pertains to my current year sales, I should book that in the current year itself, right? So that is where we book the credit losses as allowance. Okay, so you will create an allowance account. Any bad debt or credit losses will be set off against the allowance account. If allowance does not have sufficient money, the balance will be transferred to income statement. But all the bad debt or credit losses will go to the allowance account only. So always check the allowance account whenever you have to record a bad debt expense. Now, account receivable, when they are written off, they are charged to allowance account. So if I also prepare the ledger, account receivable, if there is a bad debt, I will say by bad debt or by write-off. Okay. And this bad debt or write-off is transferred to the allowance account to bad debt or write-off. So you'll have one more account called bad debt. Here you will have by, oh, sorry, I didn't note it down. I'm again repeating that. The screen was not visible. So if you see the ledger account also, there is account receivable. Let us say there is a bad debt or there is a write-off of 1,000. This write-off of 1,000 is actually transferred to allowance account. 1,000. So here you will say by allowance 1,000. Here you will say to allowance. Or you can have one more pool account called bad debt account, where you will say in the bad debt to account receivable 1,000 by allowance 1,000. So if you see the movement, this loss of 1,000, this loss of 1,000 came here, and from here this got transferred to the allowance account, right? So expense account is not impacted directly. That is what we are trying to understand. And this you have already seen. You will show it as the net amount. Now, how do we calculate the amount of allowances? So there is one approach called income, statement approach, where we take a percentage of sales to determine that yes, this should be the allowance for credit losses. So let us have a look at this question. Midburg company has the following unadjusted account balances. Unadjusted means closing entries have not yet been passed. Cash 85,000. Account receivable 100,000. Allowance for credit sales 200,000. Sales on credit 500,000. So the total sales on credit is 500,000, and based on its experience, Midburg expects that credit losses to average 2% of credit sales. So they're expecting that 2% of credit sales will be required, right? Now, the estimated credit loss for the period is 10,000. Estimated credit loss for the period is 10,000. This 10,000, again, the question will be specific as to whether this 10,000 is on the current period or the total period. Now, whenever we are using income statement approach, please remember, current period sales. On this, you will apply the percentage, and this will be the allowance. Sir, do we need to check the opening allowance? No, because opening allowance is based on income of the previous period. If we don't need that, that's a different thing. But current sales into percentage will be the fresh allowance. This is the fresh allowance that has to be created. Now, in this case, they have said 500,000 into 2%. That gives us 10,000. So 2% means 1% means 2 zeros are gone. 5,000 into 2, 10,000. This 10,000 is the allowance. This is fresh. In income's approach, if you are following the income approach, opening balance does not matter unless the question mentions that the opening balance is not required. So if you are following the income approach, opening balance does not matter. Opening balance does not matter. So 10,000 is my current allowance. This is the current year allowance. 2,000 is my opening balance. So total is 12,000. Total allowance is 12,000, right? Then what is my account receivable balance? Account receivable balance is 100,000. Account receivable balance is 100,000. So the carrying amount will be 100,000 minus 12,000, which is 88,000. Please remember, when you are following the income approach, we are using the income as a basis. We are not using the closing balance of debtors as a basis. We are using income as a basis, and hence you will add it to the opening credit loss allowance. Now, if you are following the balance sheet approach, now what is the balance sheet approach? In balance sheet approach, you are saying this was the income statement approach. In income statement, you said sales basis. Second one is balance sheet approach, that is account receivable closing balance into percentage. Now here, the total credit allowance should be equal to this particular number. In case of income statement, the credit allowance is percentage of that income for the year, whereas here it is total, right? So coming back to the question, using the data from example 1, assume that based on Midberg's experience, 6% of accounts receivable are determined to be uncollectible. So how much is the account receivable? 100,000, right? So account receivable closing balance is equal to 100,000. Okay. Then they expect 6% of account receivable are determined to be required or allowance for credit losses. So allowance for credit loss is equal to 6% into 100,000, that is equal to 6,000. This should be my closing balance. This is my closing balance. I already have an opening balance of 2,000. 6,000 should be my closing balance. 2,000 is my opening balance. So net expense for the year or increase in provision that is required or increase in allowance that is required is 4,000. So my expense will be 4,000, and in the balance sheet I will say 100,000 minus allowance 6,000. I will present this at 94,000. Okay, right. These are simple again, basic things, but as we progress, as we see the MCQ question, there will be some or the other kind of tricky adjustment that we must be careful about, and these small concepts can be combined into a single essay, and that can also be tested in the examination. Now, a lot of time what happens is a single rate may not be appropriate. So if you look at the PDF, we have different aging of account receivable. Aging means what is the period for which they are outstanding, and please tell me, as per your understanding, I'll just put two data here. Let's say there is one customer A, this second customer B. This customer dues outstanding for more than 1 year. B, it is outstanding for less than 90 days. Which customer has higher probability of not paying or higher probability of defaulting? Assume for both the cases, the credit period allowed is 180 days only. The company normally gives 180 days as the credit period. So in which of the cases is the default expected to be higher or credit loss expected to be higher? In case A. Now, why is it case A? See, the longer the outstanding, the lesser is the probability that the customer will pay, or greater is the probability that the customer will default. Because if 180 days is the credit period, it is already more than 1 year and the customer has not yet paid, which means that the customer will not be in a good position to pay, or the customer may default, right? So that is where probability is higher. So we cannot have a single rate for both the parties or for different aging schedules. So what we have is we have something called as aging analysis. Now this you will be doing in almost all the finance and management accounting function wherever you work. Every company would want to know what is the aging of receivable and what is the aging of payable. More likely they are interested in aging of receivable. Aging means depending on the number of days after the due date or depending on the number of days after the first sale, what is the amount outstanding? So general classification, and this will be used whether you are working in management accounting function or whether you are working in financial reporting function. This is one thing which even the auditors will be asking, right? So what does this mean? This classification, if you see, less than 30 days, 31 to 60 days, 61 to 90 days, more than 90 days. Now, what does this mean? This means from sale till 30 days. So customers who have amounts outstanding up to 30 days is in the first column, then 31 to 60 in the second column, 61 to 90 in the third column, 90, more than 90 in the fourth column. And here you have amount breakup. 0 to 100, 100 to 1000, 1000 to 5000, 5000 to 10,000, and more than 10,000. Now, two things. Aging is to understand the probability of default. Amount breakup is also important because, see, if I can focus on these larger amounts, if you see, that typical Pareto principle which works, 20 to 30% of items account for 70 to 80% of your value. So here also, if you see, out of 1 lakh, these high value items, 500 to 1000 and more than 1000, they themselves account for 46 plus 12, 58,900 of up to 60% come from these two categories. So what the companies would want to do, they would want to focus on high value items. Where is the maximum amount outstanding? Small amounts, $100, $10, $5, they will not have a great impact. Okay, even if you collect that, you will not have a great impact. But something which is outstanding 12,000, it's a big number. One shot, if you collect, your receivables will go down significantly, right? So this is an aging schedule which tells us amount wise or range wise and age wise what is the breakup. Then now, what is their expectation? Their expectation is less than 30 days, amount uncollectible is 2%. So if you come back, less than 30 days, total amount is 71,000. Out of this 71,000, they're saying 2% is uncollectible. So they will create a allowance for 2%. 30 to 60 days, 18,000, 12% is uncollectible. 61 to 90, 10,000, 15% is uncollectible. More than 90, 1,000, 20% is uncollectible. So if you put all of this becomes your allowance, right? Now, one more thing you have to keep in mind is, how do we determine this percentage? The management has to make an estimate looking at the past data, past transaction, past default rates. The management will try to make an estimate as to what should be the estimated uncollectible amount. So here 5280 should be my closing balance. I already have 2,000. So net amount will be 3,280, for which I will be passing a expense. So credit loss expense is 3,280 and allowance for credit loss is 3,280. Now, two simple things to calculate the ending balances. You can prepare the ledger accounts also, or you can prepare a statement also. So let us say you have account receivable. You will take the opening balance to balance brought down. Right, to balance brought down, whatever is the number, 1, to sales, number 2, right? Then you will collect the money by cash, number 3. If at all there is some amount written off by credit loss or by amount written off, by credit loss or by amount written off, 4. Again, you will not be required to prepare these ledgers. It is more for your understanding, right? So closing balance, which is your by balance carried down, will be 1 plus 2 minus 3 minus 4. 1 plus 2 minus 3 minus 4. This will give you the closing balance, which is number 5. So if you have to prepare it in a statement format, you simply take opening balance, credit sales, then cash collected, amount written off, and 1 plus 2 minus 3 minus 4 will give you the closing balance. Nothing new. You would have already, done at, multiple levels. More for this is getting comfort on how to calculate the closing balance quickly. You should not be wasting time in writing down all the statements in detail. Opening balance of account receivable at the beginning of the period. All that is not needed. If you know the numbers, just say 1 plus 2 minus 3 minus 4. That should give you the closing balance. And that is how you will save time in the examination. Right. Then, second reconciliation that you need is the allowance for credit loss. Allowance for credit loss, please remember, it is a contra account. It will have a negative balance or credit balance. So you'll have by balance brought down, which is number 1. Then in this allowance for credit loss, any expense of bad debt or amount written off will be recognized in the allowance account. So to credit loss, whatever is the amount recognized, you will recognize it here. Then credit loss recognized, whatever is the credit loss recognized, that is the estimated, credit loss which is recognized, that is put here. Then you have let me just rephrase this. Allowance for credit loss. This is the balance sheet account, which is a contra account on credit side. By balance brought down means whatever is the balance brought forward from the previous period. So that is put here. Then amounts written off, that should come on this side. To amount written off or to account receivable, whatever is the amount that has been written off will be set off against this opening balance. So this will be 2, right? So for example, if this is 1000, this may be 500, whatever is written off. It may be higher also. It may be 1500 also. That will anyways come as the closing balance or the balancing figure. So balance brought down here minus amount written off. So from this allowance balance, you will write off whatever has to be written off, right? Then whatever has to be provided in the current period by credit loss expense, that you will credit to this account, right? And this will give you the closing balance, which is balance carried down, whatever is the number. So balance brought down, let us say 1000 minus, first you will, whatever is the amount written off, 500. So this is 1, this is 2, plus whatever is the allowance needed for the period, let us say 1500. So the closing balance is 1000 minus 500. 500 plus 1500, 2000. This will be the closing balance. Okay. So the same thing if you apply to what we have discussed here, opening balance of credit loss, allowance for credit loss balance is 2000. So that is one number. We'll just remember that. Then expense amount written off is 1500 and closing requirement is 2500. So 2000 is the opening balance. 2000. Closing balance requirement is 2500. This is the closing balance we already have. Then amount written off was 1500. So this you will reduce here, minus 1500 written off amount. So 2000 minus 1500, 500. You need to provide credit loss expense of 2000 to arrive at 2500, right? So like that, you can use the formula. If you look at it in the statement format, opening balance of credit loss. From this amount written off from account receivable. This is first, this is second. Then credit loss, third. This will give you the closing balance. Now, one thing if you have observed carefully here, amount written off, I am saying written off, provision, I am mentioning it as credit loss. So this you can say provision for bad debt for the period kind of a nature. Now, sometimes what happens is previously written off customers will pay us the amount. Previously, whatever amounts we have written off, the customer will pay back the amount to us. Now, if they have paid back the amount to us, written off is negative number. If they pay back, collection of previously written off amount, you will have to add back. Okay. So this is one more adjustment which you have to keep in mind, which will be added back to the overall balance, right? Because written off, we are reducing. If we collect it back, we will add back. So these are the two reconciliation summaries. You can make a specific note of this. Important to know the computation so that if at all there is an MCQ, you can quickly calculate that in the examination. Right. So moving on, we have allowance for customer right of sale return. Now, all of you would be buying something from Amazon or Flipkart where they say 10-day return. You buy something, you can return within 10 days. Now, let us say we are on 25th of December. 31st December is the financial year end. Some customer purchased on 25th December. Now, the customer has a right. The customer has a right to return this product till, let us say, 5th of January 25th is the purchase. Till 5th of January, the customer can return the product. Now tell me one thing. If let us say on 25th of December, Amazon sold this for $10,000. When should Amazon recognize revenue in respect of this sale? In which year? Should we recognize in the current year or should we recognize in the next financial year? 31st December is the year end. Current year, okay. 31st December, okay. 31st December. Now, if you look at the given transaction, Amazon has transferred the goods, but if the customer rejects, the sale is not completed. If the customer rejects the product, sale is not completed. If the sale is not, because see, if the customer says, okay, the product is damaged, I will not accept. So, one key criteria of recognizing revenue is that risk and rewards must be transferred. Now, in this given case, tell me, as on 31st of December, does Amazon have any risk? As on 31st of December, has Amazon transferred the risk to the customer or does Amazon itself has the risk of the product? Who has the risk of the product? Is the risk transferred? The risk is still with Amazon because if the product is defective, the customer can say, I don't want the product. So the Amazon has to bear the risk. Okay. So if you look at transaction by transaction basis, the risk and rewards have not been transferred till the time the customer accepts the product. So because the risk and rewards have not been transferred, Amazon technically cannot recognize revenue for this particular transaction. So whatever transaction whatever transaction you're seeing on the screen, for this, customer has not yet accepted. If the customer has not yet accepted, Amazon cannot recognize revenue. Amazon cannot recognize revenue. But then for Amazon, this is not one transaction. There are thousands of transactions every day. And it will be very difficult to track which product will be returned, which will not be returned. And most of the times, maybe 98% customers will accept. So what you can do is, thinking that 98% of the product or 98% of the times, customer will accept. For 2% cases, we will create something called as allowance for return. Means we are creating a kind of provision for sales return. We are creating a kind of provision for sales return. That is, the customer will return the product in 2% of the time. So out of this 10,000 for 2%, that is for $200, I will create an allowance or I will create an expense. So when a right of return exists, an entity may recognize revenue from sale of goods at the time of sale only if the amount of future returns can be reliably estimated. So a provision must be made for the return of merchandise because of product defects or customer dissatisfaction, etc. And in many cases, these online portals these days, they provide no question asked return policy. Even if it is not defective, I'll return. So the other day, what happened? I had ordered some item for a birthday gift. That item arrived late. So we left for the birthday party and then the item arrived. So I came back and I returned the product. Correct. So the company must provide for a provision, or they should create an allowance saying that the customer has a right to return and hence this much is the expense for which we must be recognizing the right to return. And this is in consistency with the matching principle, because if I am recognizing 10,000 of revenue, relevant return liability of 2,000 or provision for 2,000 must also be recognized. Okay. Moving on, another very interesting aspect and which you would get to deal in some of the companies if you're working with, which is called factoring of account receivable. Now, so what is this factoring of account receivable? Say there is an entity A. There is a customer. This entity sold goods worth, let us say, $1,000 to the customer. The customer has to pay to the entity within 90 days, right? Now, what happens is the customer has to pay within 90 days, but A may be in urgent need of funds. So if A is in need of fund, what can it do? It can ask the customer to pay, but the customer will say, I have 90 days credit period, I will not pay. So what A can do is A can reach out to a third party called a factor and say and tell the factor that I have to receive $1,000 from the customer. Okay. I will sell this $1,000 to you today, whatever I have to receive in the future. So what are we doing? We are selling future cash flow stream or a future cash flow. I have a future cash flow of 1,000. I will sell it to you today. So I'm not selling. When I'm saying selling of account receivable, I'm not selling the customer. Okay. I'm selling the cash flow from the customer. I tell the factor, Mr. Factor, I have to receive $1,000 from this customer. Please buy this. So I will sell this. Now, when I sell this, the factor has to pay me the money. The factor will pay me some amount. Will it pay 1,000? It will not pay 1,000 because 1,000 is after 90 days. So factor will think, okay, for 90 days interest, let us say interest, for example, 90 days interest is 100. Okay. Then 100 rupees they will deduct. But just by interest or just by deducting interest, the factor may not be satisfied because factor has to collect the amount from the customer. When you have to collect the amount from the customer, you have to follow up with the customer. There is a, they may give check, the check has to be deposited. You have to maintain account. So there are some collection expenses also associated with the, amount that you collect from the customer. So the factor has to recover that. And on top of it, the factor is also bearing some risk. The factor is also bearing some risk. For example, if the customer does not pay, the factor may lose, right? And also the factor wants to make profit. See, the factor will not do business only for interest. They also want to make profit. So all of this put together, let us say 50 rupees is your commission. 50 rupees is your commission. So what the factor will say, okay, 100 minus 50, 150. I will pay 850 to you today. On the due date, this customer has to pay to the factor 1,000. Sometimes what also happens is, from this 850 also, they will deduct 100 rupees as deposit. And they will only pay back 750, saying that 100 rupees will be paid after we collect the amount from the customer or after 90-day period. Some arrangement like that. Okay. So factoring is a process. If you see, an entity has a customer, the customer has to pay amount to the entity. The customer will pay after 90 days. So the entity sells the cash flow to the factor. Factor will deduct its interest and commission. All of that details will be given to you in the question. Balance amount will be transferred back to the company. So company receives 850 today and factor will receive that 1,000 after 90-day period. Now, here I said this factor has risk. Risk of what? This customer defaulting. Right. So what the factor can do, there are two types of factoring arrangement where we say recourse and sans recourse. Okay, sans means without. Sans means without. So I don't know how many of you have observed that whenever you use Word, right? All of you might be using MS Word, right? Microsoft Word. So in Microsoft Word, there are a lot of fonts with sans, correct? Open sans, something sans. Have you seen that? Okay, if you have not seen, maybe you can check it out. Whenever you see the word sans, this means without. Okay, in font, sans means without that sharp edges. So that is what is called sans. Here, recourse means if the customer does not pay. If this customer does not pay, factor can ask the payment from the company which has sold to the customer or the company which has sold the factor. So when we say recourse, risk of default is borne by seller. If we say sans recourse, sans means without recourse, you cannot go back. Force is away, you cannot go back. Here, the risk is that of the factor. So, I have two types of arrangement: recourse, with recourse, and without recourse, or recourse and sans recourse. Okay. So, what is factoring? Factoring is transfer of receivable to a third party known as a factor who assumes the responsibility of collection. Factoring discounts receivable on a non-recourse or notification basis. Payment on the transferred assets are made to the factor. Okay. So if there is a non-recourse factor, payments are made to a factor. If the transferor surrenders control, the transaction is a sale. Now, what does all of this mean? Basically, all of this basically means is that if it is without recourse, means risk is with the factor, which means account receivable have been sold. So funny part of it, you make a sale, you recognize account receivable, and now you are selling the account receivable itself, right? That is what is the meaning of this part. So if the transferor surrenders control means risk and rewards are transferred, then the transaction is treated as sale. So if a sale is without recourse, the transferee, that is the factor, assumes the risk and receives the reward of collection. The sale is final and the seller has no further liabilities to the transferee, and the receivables are no longer reported in the seller's financial statement. So if it is without recourse, the risk is transferred to the factor. So here let us say risk is transferred to the factor. I don't have any receivable left. I do not have any right to receive the money from the customer because the right to receive has been transferred fully. I don't have any further liability also. So what will we do? We will de-recognize the account receivable. We will de-recognize the account receivable if it is without recourse, because the company does not have any right to receive money from the customer. So if you don't have right to receive money from the customer, you will de-recognize the account receivable as if you have sold the receivable. If the sale is with recourse means what? With recourse means the factor can come back to the transferor and say, your customer did not pay me the amount. Please pay the balance amount. So if the transferor, if the sale is with recourse, the transferor may be required to make payments to the transferee or buy back the receivables in specific cases. For example, if there is a default, the customer does not pay the amount to the factor will come back to the company and say, I need my money back. Please buy back the receivables from me. So in such circumstances, the transfer generally does not qualify as a sale. And if it does not qualify as sale, what happens is, you have a customer, you have an entity, you have a customer, you have a factor. If it is with recourse, this factor does not take up the risk. The entity still has risk of default. So this customer cannot be de-recognized. The customer is continued in the books. But then what about the money the factor paid? Factor paid 750, right? You will say debit bank, credit liability. So why liability? Because till the time the customer pays the amount to the factor, I have the liability. So 750. If it is without recourse, then debit bank 750, credit receivable 1000, debit expenses 250. If it is without recourse, the receivable is de-recognized from the financial statement. If it is with recourse, the receivable are on the seller's financial statement and a liability is recognized for the cash received. So just to summarize the discussion we had, factoring means selling of receivable. It can be with recourse, without recourse. If it is with recourse, account receivable cannot be de-recognized. Whatever amount is received, that is recognized as a liability. If it is with recourse, account receivable cannot be de-recognized and liability should be recognized. If it is without recourse, then the asset or the receivable will be de-recognized. So why would the seller sell AR with recourse? Now the thing is, look at it from the point of view of the factor. If you look at the factoring risk, high or low? Now tell me, for the factor, is with recourse high risk or without recourse high risk? For a factor, is with recourse high risk or without recourse high risk? I'm repeating my question. With recourse high risk or without recourse? So there is a high risk in without recourse, low risk in with recourse, relatively. Now, if risk is high, I will charge a higher amount. So here, remuneration that you will charge will be higher. Here it will be lower. Maybe here it is 10%. Here you may do it for 8%. Right? That is the first thing. So for the transferor or for the seller, if they want to save on this cost and they are confident that their customers will not default. For example, my customer is Tata Group. If my customer is Tata Group, I know Tata Group will not make a default. So I can go with recourse that if Tata does not pay, I will pay. Now that situation may not arise, right? In 99% of the times, such big companies having great rating will not default. So I will go with a lower one because I have a lower remuneration or lower commission to pay. Second thing is the factor may not be comfortable with some kind of customers. The factor may not know the customers because they may not be knowing each and every customer. Each and every customer may not have a great credit profile. In that case, the factor may say, I cannot take the risk. So in that case, you will have to go with recourse. Am I clear? Right. So depending on the circumstances, if the seller is also comfortable that even if I go with recourse, I know my customer will not default, they will save some money in terms of your transaction charges. Now, how does it work? Calculation, please pay attention. Calculation is very, very important. A factor charges a 2% fee plus interest at the rate of 18%. So 2% is a flat fee and 18% of interest on all cash advance to a transferor of account receivable. Monthly sales are $10,000. Monthly sales are $100,000 and factor advances 90% of receivable submitted after deducting the 2% fee and interest. So what happens is if sale is 100,000, they will first deduct 10%. This 10% is like a deposit. And on top of that, they will deduct 2% fee. And on top of that, they will deduct 18% interest. Credit terms are net 60 days. What is the cost to the transferor of this particular arrangement? So now here 2% fee plus interest at 18%. 10% is the reserve, right? So if monthly sales are $100,000, this is the sale. First, what they will do, they will deduct 10% reserve. That is 10,000. Okay, then they will also deduct 2% of fee. Please remember, fee unless otherwise specified is on the total sale value, which is 2,000. So 100,000 minus 10,000 minus 2,000, they will give the factor 88,000. They will give the factor 88,000. Or gross amount, gross amount to be given is 88,000. But then they will also charge interest. Interest at how much? At 18%. Now this 18% should be calculated on what term? Now if you look at the question, it says credit terms are 60 days. So the factor will receive after 60 days. So the factor will charge 60-day interest to the customer or to the seller, which is 88,000 into 18% into 60 days divided by. Now, most of the calculations you can do using 360-day basis. Generally, the question will have that you can do it on a 360 basis. So 88,000 into 60 divided by 360 into 18% if I do, I get 2640. So 2640 is the interest. 88,000 minus 2640, that is 85,360. So on day 0, the factor will pay 85,360. This 10,000 will be paid on 60th day, once the money is received from the customer. This 2,000 is the fee and 2640 is the interest that is charged. Right. Now, what is the question? The question is, what is the cost? The cost to transfer is 2,000 of fee and 2640 of interest, which is 4640. 40. Now you may have a doubt, sir, why this reserve is kept? See, this reserve may be kept. Maybe there is some adjustment needed for sales return. Maybe there is a adjustment needed for sales return or some discount, some credit note, some debit note, the customer may not pay, right? So considering all of that, you have this reserve which is kept. Now, why do we enter into factoring transaction? One, I can collect money in advance. Second, I can give. First, sorry. So why do factors enter into this kind of arrangement? The first one is you can outsource your collection activity. My business is to focus on my business. The collection part, I can outsource it to a third party. I can get money in advance. I can receive money in advance. So, liquidity position improves, right? Then I can, reduce the accounting team, account receivable staff, collection staff, sales people who will have to focus on collection. All of those things I can avoid. Sales can focus on sales. Collection will be taken care by a independent third party. And if it is with recourse, then the credit risk is also transferred. Bad debt and all are not recognized, right? Now, against all of this, there is an increased cost of factor as well, right? Because there is a factoring commission that is charged. Then, they also charge interest. All of that is, one thing where the customer or the seller tries to benefit. They try to streamline their collection process. Now, credit card sales are common form of factoring. This is one thing. Like another example to give you, not typically factoring, EMI basis. These are not factoring actually. For example, if there is a student, with Indigo Learn, and I have a student, right? Now, the student wants to enroll for a course. We have an option called no cost EMI. Okay. Now, I have a third party provider. So, the third party will pay the amount to me and student will pay the amount to the third party, right? Now, these kind of arrangement, technically not factoring, but type of factoring. Similarly, credit card transactions, credit card EMI transactions and all of that. There is also, a good example of factoring or how we can manage the receivables. So with this, we complete the receivable part, easy. Just that you need to, get well versed with the terminologies used, especially allowance of credit risk, allowance of credit losses, and the factoring related aspect. Now we'll start with a few MCQs from the book, and then we'll continue with inventory. It's a simple chapter, but what tends to happen is when they ask question where you have to select how much is the increase in asset, how much is the decrease in asset and all of that. That is where sometimes it can become challenging. Otherwise, it is easy. It's not very difficult topic as such. Something which you would be doing on a day-to-day basis as well. Right. Okay. So let's have a look at the first question. The following information applies to a manufacturing company which has a 6-month operating cycle. Now, why have they given 6-month operating cycle? 6-month operating cycle is important for us to classify something as current or non-current. So 6 months means anything within 12 months will be non-current because operating cycle is less than the 12-month period, right? Now, what have they given? They have given information about cash sales, 100,000. Credit sales during the 6 month with net 30-day term. Now, this net 30-day term means you have to pay within 30 days. One more thing, sometimes the terminologies which are used is something like 2/10 net 30. This means if you pay within 10 days, you get a 2% discount and normal credit period is 30 days. So if you pay within 10 days, you get 10% discount. This is how the standard number is done. Then credit sale during the 5th month with special terms of net 9 months. So what has happened here? Credit sale during the 5th month. So this one is credit sale during the 6th month, credit sale during the 5th month with special term of net 9 months. So here it is 9 months. Then interest earned and accrued on an investment that matures during the month 3 of the next cycle 2000. So they have given us multiple information. The first is in the 5th month, there is some sale. In the 6th month, there is some sale. And in the next cycle, so let us say 12 ends here. In the next cycle, in the 3rd month, there is some investment where you will get interest. So there is interest accrued. Now, interest accrued is also your asset. Now, question is, what should be the company's trade account receivable at the end of the current cycle? Means at the end of the current financial period, how much should be the trade receivable? Now, there are 4 options given. Can you take a minute and make a guess as to what should be the trade receivable balance? What should be the trade receivable balance? I'll show the full question here. So, okay, one more thing. I think I took it as a 12-month cycle. We have been asked at the end of 6th cycle. So, 5th month, 6th month, then you will have again 1st month, 2nd month, 3rd month. Okay, so please ignore this. So there are some sale in the 5th month, there are some sale in the 6th month, and there is an interest receivable in the 3rd month of the next period. The question is, this 5th month will be received after 9, 6 months will be received after 30 days. So what is the account receivable balance? Come on, what is the account receivable balance at the end of the current cycle? That is at end of month 6. What should be the outstanding account receivable? B, which is 160. 160, how 160? See, cash sales will not be your account receivable. This 6th month sale, which will receive after 30 days. 6 month sales, which you will receive after 30 days. This will be outstanding. 5th month sale, which you will receive after 9 months. This 10,000 is outstanding. This 2,000 is not your account receivable. So what happens is sometimes we get confused as 150 plus 10, 160 plus 2. We may choose 162, but this is not the right answer. Only these 2 are your account receivable. Okay. Now, these type of questions is where you need to think more and answer, because numbers are not given, right? Second question, what I'm referring to. A company uses the allowance method to account for uncollectible account receivable. After recording the estimate of credit loss expense for the current year, the company decided to write off in the current year the 10,000 account of a customer who had filed for bankruptcy. What effect does this write-off have on the company's current net income and total current assets respectively? Now, what is the meaning of this? The meaning here is, we use the allowance method, means we create allowance. Okay. After recording the credit loss expense, so the first entry, that is credit loss expense to allowance, this entry is already passed. After this entry has been passed, they decided to write off 10,000. So after this entry has been passed, the 10,000 has been written off. Always remember, any write-off should be set off against this allowance account. Any write-off should be set off against the allowance account. So, for example, let us say this is 20,000. This is also 20,000. When write-off happens, you will say debit allowance, credit receivable 10,000. 10,000, or you can say debit allowance, debit bad debt, credit receivable, then debit allowance, credit bad debt, the impact becomes the same. So whatever amount is written off from the receivable will be set off against the allowance account. Now, question is, what impact does it have on net income and total current asset? What impact does it have on net income and total current asset? Now tell me, when I pass this entry, what is the impact on net income when I write off? When I pass this write off entry, what is the impact on net income? Will my net income change? When I pass this debit allowance and credit receivable entry, will my net income change? It will not change. Net income changes with this entry. So here net income will change, here net income will not change. Now the second question is, will my current asset balance change? Will my current asset balance change? Why will my current asset balance change? If at all you are saying my current asset balance changes, why will my current asset balance change? Account receivable credited, and we are saying the balance will change. But please keep in mind, our presentation in the balance sheet is account receivable minus allowance. Say for example, 100,000 is my account receivable, 20,000 was my original allowance, this is 80,000. Now, after 10,000 has been written off, account receivable becomes 90,000 and allowance also becomes 10,000. So again, this also becomes 80,000. So both the places we are reducing. The receivable is with this entry, the receivable is also going down, the allowance is also going down. So the account receivable balance that you present in the balance sheet, the current asset, there will be no effect here, there will be no effect here. So option D is the right answer. Now, this kind of question is where sometimes it becomes challenging to answer in the examination, because if you give a numerical, it is easy to solve. If you have to read and evaluate, that is when it becomes challenging. Okay. Now, the next question. A company had the following account balances at 31st of December. Account receivable 900,000. Allowance for credit losses. Allowance for credit losses before any provision for the year. So before the current year, allowance is 16,000. Then the company is considering the following methods of estimating credit loss expense for the year. Based on credit sales 2%. Based on credit sales 2%. Based on account receivable 5%. What amount should the company charge to the credit loss expense under each method, either as a percentage of credit sale and percentage of account receivable? How much should be charged? So what is the question saying? 900,000 is the account receivable. Allowance for credit loss, currently it is 16,000. Credit sales for the year, 175,000. Now, if it is based on credit sales, the question says 2%. So, 175,000 into 2%. And when we are following the sales method, entire amount is charged to the expense account. So 35,000 should be charged. So either option C or option D would be the right answer. Then on the basis of account receivable, 5%. So 900,000 into 5%. 45,000. Now this 45,000 should be my closing balance. Just don't say because there is 45,000, you may take C. 45,000 should be my closing balance. 16,000 is my opening balance. So the expense will be 45,000 minus 16,000. That gives me 29,000. So 29,000 and 35,000. Similar to the problem that we had discussed in the class also. Please remember, if it is based on income or sales, total amount will be the expense for the period. If it is based on the balance sheet number, only the differential portion will be our expense. Any question in this question? Any doubt in this question? Right, straightforward. Yeah. Now, next one. Just a second. Yes. Just give me a moment. Yeah. The fourth question. Based on the industry average, a corporation estimates that its credit loss, losses should average 3% of credit sales. So we are saying 3% should be our credit loss of sales. The balance in the allowance for credit loss at the beginning of year 3 was 140. During the year, credit sales totaled 10 million. Accounts of 100,000 were deemed to be uncollectible and payment was received on a 20,000 account that had previously been written off as uncollectible. The entry to record credit loss expense at the end of year 3 would include an increase to the allowance for credit losses of how much? So basically, the question is saying how much should be the expense for credit loss allowance for the period. That is what the question is saying. Multiple things we have already, discussed in our class also. We'll again see how should we approach this particular question, again solve this particular question. Now, here the question says, estimates that its credit losses, so let me just write here. Credit losses should be 3% of sales. So this entire amount will be the expense for the period, first thing. Then the balance in the allowance of credit losses at the beginning of the year was 140. Now, whatever was there in the beginning of the year, that will not have an impact in the current period, because whatever is this percentage of sales, that will go to the expense. So opening balance for now doesn't matter, but we have to check if any extra has to be provided. Okay. So 3% of credit sales, right? Credit sales total 10 million. Credit sales total 10 million. So allowance for credit loss should be 10 million into 3%, that is 300,000. Okay, then payment was received on a 20,000 account that had previously been written off, and 100,000 were deemed to be uncollectible. Now, what does this mean? This basically means that opening balance, what they have given here is 140. Okay. Now we have written off something. So from this opening balance, whatever has been written off, 100,000, you will reduce, add collected 20,000, you will collect. So 140 minus 100, 40 plus 20, 60,000. This is opening balance. This is related to previous year balance. Then current year expense will be based on what is the percentage of sales, which is 300,000. So for our answer purpose, option A is the right answer. So you might be wondering, sir, what about the opening balance adjustment? Whatever amount you have written off, whatever amount you have collected, that will be adjusted from the beginning period balance only. Okay, that will not be an expense for the current period unless there is a higher amount of expense. But again, that will not be a part of current year allowance, right? Because we are following income approach. So whenever there is an income approach, it is based on the percentage of sales, and that is what you have to understand. Okay, now if this was the balance sheet approach, then you would have said opening balance 140, less written off 1, add collected to 60,000, then closing required 300,000. So the expense would have been 240,000 for the period. So if it was balance sheet approach, then that would have been C. But because we are following income approach, it is C. So you need to practice, a few more questions on this line so that it is more clearer. Any doubt? And if required, we did this thing yesterday also. This part, what we did, that is what you have to keep in mind, and that will help you understand. Balance sheet approach is the balancing figure approach, and income statement approach is the based on the percentage of income. Now, next one. The following information has been compiled by a manufacturing company. Sale of company product for the period to customers with net 30-day terms amounting to 150,000. So net 30-day term is the thing. Then means they will pay after 30 days. Sale of company product for the period to a customer supported by a note for 25,000 with special terms of 180 days. Now here, first one, account receivable. Second one, we have sold, but we have a note. So this is called note receivable. Means it is like bills receivable. The other party has given us a bill. So it becomes a bill receivable. Balance of trade receivable at the end of the last period was 300,000. Opening balance. Collection of the trade receivable 200,000. Rental income for the period, both earned and accrued but not yet collected from manufacturing companies union was 2,000. This is not pertaining to trade receivables. So that part you can ignore. The open trade receivable balance to be shown on the statement of financial position for the period is very simple. This one, basically opening balance, that is 300,000, add sales 150,000 less collection. Collection is 200,000. So 300 plus 150, 450 minus 200 will give you 250,000. So option A is the right answer. Sir, why did we not consider second part? Second part we did not consider because we have a note receivable or bill receivable. Or what you can do is, you can say sale is 150 plus 25, collection is 200, note receivable minus 25. So my final account balance is, closing balance is 250,000.